Income property is a multidimensional asset class. So you earn your return on investment from many sources. With precious metals or cryptocurrencies or non-dividend paying stocks, for example, it's pretty much a one-dimensional asset class. The whole strategy is buy low, sell high. End of discussion.
Good morning, everybody. Today we have a very special guest on the show, the wonderful and incredible Mr. Jason Hartman. Jason, welcome to the show.
Hey, Tony, it's great to be here. It's always good to talk to you.
Yeah, we always have fun conversations. So one of the things I wanted to get into, so I do some real estate consulting and try to help folks get into real estate. And one of the things I try to impress upon them is 20 years ago, when I got into real estate, I didn't have to think so much about the macro picture of things, right? Whereas today, 20 years later, I think macro is such an important piece of investing in real estate. What do you think along those lines?
Yeah, I think it's true. Understanding the macroeconomic climate is critically important. And, I think one of the real differences is our former president, Bill Clinton, he signed into law the Commodity Futures Modernization Act. And that was a tectonic shift in the way the economy works, the way the financial markets work. And Tony, that really financialized everything in our world so much more. So we live in this world of this kind of financialized economy. And what does that mean? Well, it means that sort of everything has become a financial instrument, but everything became financialized. And it became this game, this shell game. And there's a big difference between the Wall Street economy and the Main Street economy. And unfortunately, when Bill Clinton signed that into law, the whole world became much more of a Wall Street economy. And that's one of the reasons that it's so important to understand the macroeconomic and macro investing world. You can't just say, oh, I'm going to go out and buy houses anymore, and fix them up and rent them out or something. It is really vitally important that people understand some of these big macro trends. So we'll touch on some of those today, and I'm looking forward to it.
Thank you for that overview. I think that will help folks understand some of the macro piece and why I push that as far as when I'm, consulting with folks. So sticking with that theme, so the Federal Reserve has started to raise interest rates, right? The Fed fund rates, right? Which has an indirect impact on mortgage rates increasing, right? So what do you think is going to happen to the housing industry here with these mortgage rates, which seem like they're going to continue to increase for the rest of 2022? Do you think that's going to slow construction down? Do you think that's going to slow down the home buyers? What do you think?
Those are all good questions, and they're at the top of everybody's mind, including mine. So everybody is asking themselves those types of questions. So they're great questions. First off, I just want to say that I'm interviewing people for my podcast, The Creating Wealth Show, constantly, many times a week. And last Friday, I interviewed for the second time, he'd been on the show years ago, Lawrence Yun, the chief economist for the National Association of Realtors. And that's the largest trade group in the world. So they're just a huge organization. They have big research arms and so forth. And one of the interesting things he said that he thought that the mortgage market has already priced in the threats of the Fed rate increases for the rest of the year. So he actually thought interest rates would probably soften a little bit more from where they are. Now, it's anybody's guess. Grant's Interest Rate Observer is a good resource on interest rates. And, I don't know lately what he's saying, but, interest rates are very, very difficult to predict because we are in a world of a centrally managed economy. And so it's not market forces that are determining rates. It's central planners like Jerome Powell. And so it's tough to predict. But, some people will say rates are going up more. Some will say they're going to stay the same or soften. It's been pretty shocking, the increase in the mortgage rates. And so far, in terms of the housing market, it has only had the effect of increasing demand and increasing sales. Now, I'm not sure that'll last forever, but that's what's happened since the rate increases. We'll see how long it plays out. And part of that may just be the FOMO effect, fear of missing out.
Yep.
where people are really in fear of missing out on the last vestige of these historically low rates. But even with the higher rates we have, historically, they're still pretty darn good. So
Yeah,
we've got to just keep things in perspective. I mean, when I got into the real estate business, I was 19 years old, my first year of college at Long Beach City College when I got my real estate license. And I just started dabbling, selling real estate part-time because I wanted to be an investor. But back then, Tony, interest rates were 14%. And everybody thought that was a bargain because it was down from 19%. So,
exactly.
it's all a matter of perspective.
Yeah, isn't it funny how we go from a 3% mortgage rate to a 4% mortgage rate, and now getting close to 5, and folks are feeling like, wow, it's so expensive to get a mortgage these days, right? It's that short-term. Folks seem to these days only have a short-term perspective on where rates are and where rates have been.
They do, but one more thing I want to say about that. The perspective is very uneven, but for investors, okay, they pay a higher rate than owner-occupant homeowners. So for investors, mortgage rates right now are substantially over 5%.
Yeah, exactly. And
Yeah.
so maybe speak a little bit about that, as far as investors being a certain percentage of the buyer pool, right? Because it's grown over the years, right? Investors, I think they're like 30% or 33% of the buyer pool.
Yes, about 33% are investors.
Right. So they're still seeing this as a good time to buy, even with higher rates, right? Investors are typically more savvy buyers. They understand the macro trends. They understand the demographic trends. They understand the financial trends, right? So for them, 33% of investors still, piling into the housing market, still see that as a good place to be, is how I read that.
Yeah. Well, there's this acronym in the finance world, and the acronym is TINA, TINA, and it means there is no alternative. And what it really says to us is that investors or capital always chooses between the least worst alternative, right, or the best alternative. And the investment properties don't cash flow like they used to. There's no question about that. I mean, prices have gone up, interest rates have gone up, but the real question is not how are they doing compared to how they used to do. The real question is, what else are you going to do with your capital?
Exactly.
What other alternative is available? Is it an overinflated stock market that is maybe on the verge of disaster? There's a lot of talk about that. I won't go into that. You can do your own research. There's tons of opinions out there. Is it a one-dimensional asset like cryptocurrency or precious metals or non-dividend paying stocks? And what I mean there, one-dimensional, income property is a multi-dimensional asset class. So you earn your return on investment from many sources. With precious metals or cryptocurrencies or non-dividend paying stocks, for example, it's pretty much a one-dimensional asset class. The whole strategy is buy low, sell high. End of discussion. Now, I know with especially crypto, there are some things you can do, in other words, but basically the asset class is all about buy low, sell high for all of those things mentioned. Dividend paying stocks, buy low, sell high, get some dividends in between, hopefully, right? It's two-dimensional. But income property is multi-dimensional. You earn your return from so many ways. One way is a trademark technique and term of mine called inflation-induced debt destruction. And I came up with that about, I don't know, maybe 17, 18 years ago. And it is the hidden wealth creator with income property, where inflation essentially pays off your debt. It's a truly incredible thing. But besides that, the conventional wisdom is, you get income from your properties, you get tax benefits, you get leverage, meaning that when you buy the asset, instead of putting 100% down, like on all the other assets, you're only putting 20% down. And so you're getting phenomenal leverage using other people's money. It's just really the most historically proven asset class in the world, income property.
Yeah, absolutely. And maybe the first time investor doesn't fully get that piece of it. But as you become more and more involved in real estate and more of a sophisticated real estate investor, for the viewers out there who aren't familiar with this, you start to really understand the benefits of investing in real estate through appreciation, through cash flow, through your tenant paying down your mortgage, through this
Inflation-induced debt destruction. It's a mouthful.
Inflation-induced debt destruction. But you teach it very well. I've seen you present that in your seminars, and you teach it very well. So, and that's a concept nobody else in real estate really talks about, that aspect. So I appreciate you bringing that forward. So, in this day and age, we have housing prices that, I'll use the term bubble, right? Everybody feels the stock market is in a bubble. We have a housing bubble going on again right now, and for every person that says the housing market is going higher, it seems like we also have another person saying, the bubble is going to burst and the housing market is going to tank, right? So everybody has their opinion. Please give us your opinion, Jason, on where you see the housing market going.
Well, let's look at a couple of charts. And for the people listening on audio only on your podcast, we'll just explain these visuals. But for the people on YouTube, some visuals might be helpful. So first of all, where have we been? It's always good to look a little bit at where we've been. Now, of course, there's way more to it than this. But just for a couple of pointers, last year, the average homeowner gained about $57,000 in equity in their home. So that has created a tremendous wealth effect for people. And that money, that equity gain, has been used to stimulate the economy. Lots of home improvement projects, lots of stimulation of the economy through this increase in values. And in total, that's about a 31% increase in equity, not prices, equity, last year, totaling over $3 trillion. So compared to what is always the question I want to point out. Well, the US economy, the GDP of the country, is a little bit over $20 trillion. So $3 trillion is pretty significant. Okay, that's a pretty significant number. Now, let's look at housing inventory. At the beginning of this year, we started off the year, Tony, with the lowest housing inventory ever since they've been recording this stuff. Okay. And basically, that was just under 300,000 homes for sale. Now, this is Altos research data. The National Association of Realtors has a different way of calculating this, and I prefer this method because the National Association of Realtors, the way they calculate housing inventory is they include all contingent and pending sales. Those aren't really available. They're just kind of assuming they might fall out of escrow. And, for the few transactions that do, sure, that'll be housing inventory that comes back on the market. But largely, I think this is a better way. These are truly listed properties that really are available, okay? Just under 300,000. And if you thought that was low at the beginning of year, and let me give you the compared to what on that. The experts will tell us that a normal housing market, a balanced market, you need about 1.2 to 1.5 million homes for sale at any given time. So there's your comparison. Now, that was the beginning of the year. But as we moved in a couple of months into the year, it got even worse. The housing inventory got even lower and went down from 293,000 homes for sale to 241,000 homes for sale. So this is lower than the lowest ever recorded inventory. But what does that mean? It helps if you can visualize it, right? It would be like walking into the grocery store and seeing 66 to 80% of the shelves in the grocery store empty. So to get back to a quote unquote normal market, we need to see housing inventory increase by 300 to 500%. So for all of those people waiting for some big correction or big crash, don't hold your breath. Now, of course, watch this. If housing inventory does increase, that's going to signal a change. But just know, to get to a normal market, not a housing recession, not a bad market, not a buyer's market, just a normal market, we've got to see 3 to 5 times the amount of inventory that's currently available. That's a huge increase. It's a huge increase.
So when we couple this with the macroeconomics of things, right, and we take a look at the Fed increasing rates, right, and what damper that might put on construction, right, new starts of homes, right, that's not going to help with bringing more supply to market, right?
The thing with the home building industry is they have to act pretty far in advance.
Mm-hmm.
So the kind of thing you notice is that home building slowdown takes a while to work its way through the system. But there is so much demand and supply is so short and construction materials are so expensive. I mean, the construction material cost has just skyrocketed and it doesn't look like there's really any end in sight. Goldman Sachs predicts that we are in a commodity supercycle that is going to last a long, long time. So we'll see, but the home building is going to take quite a while to catch up and fill those supply gaps.
Yeah, so we have this supply shortage that you very nicely presented, where we are today and where we need to be, right? So we have a supply shortage putting pressure on prices. We have
upward pressure on prices.
Upward
Yep.
pressure, correct. Yep. And then we also have this supply constraint with building materials that is, these commodities that are going to put upward pressure on home prices, right? So when we look at prices today, it seems like they're going to need to go higher, right, to fill the need.
It looks that way. Now, the funny thing is, people, Tony, make these really half-baked, very linear thinking statements that just are nonsensical to me. And I want to address that for a minute because people say these crazy things like, well, hey, Jason, if interest rates go up and housing prices, they're already so high, people just aren't going to be able to afford a house. So they're not going to buy, and that's going to cause the market to tank. Well, let's really unpack that a little more, okay? It's not that they're not going to buy a house. They might not buy a house, but then they have to rent a house. So I teach a strategy called the 3 dimensions of real estate, and that basically addresses the idea that when you don't buy, there's more people who are forced to stay in the renter pool, and that puts upward pressure on rental prices. And of course, we've seen rental prices skyrocket. So when you're an investor and an owner, the beautiful thing about income property, among other things, is that you can simply adjust your strategy for what's going on. Sometimes you're in a market where it's a capital gains strategy, where you're making a ton of money off appreciation. Other times you're in a market where you sit back and you're just collecting and increasing rents over time. And that's a cash flow market. So either way, as long as you're mindful of those trends, those macroeconomic trends we've been talking about, you're going to be in a position where you can win either way, right? And that's a really important thing for investors. But the sort of linear, half-baked idea of, well, the housing market is going to crash because people can't afford a house, right? That doesn't make any sense to me. And here's why. Maybe the question is, what gives? Right? What has to happen? What gives? If interest rates are higher and housing prices are already high, what gives? How can it continue? Well, here's what gives. What gives is the standard of living, the quality of life. It simply declines. And so let me just share an example. And since you're in the Northeast, you'll understand this example. New York City is not too terribly far from you. And I live in Florida now, and these are very different markets. So if anybody can envision or has actually had the personal experience of moving from a low-cost real estate market to an expensive real estate market, it's comparable to this idea of when the market changes and what people simply have to give up. They simply have to accept less. So here's a good visual way to illustrate that. This is a property I just found about 3 weeks ago on Zillow. It's in Jacksonville, Florida. It's $1 million, okay? So this is what $1 million buys you right now in Jacksonville. Almost 5,000 square feet, a McMansion basically, a beautiful home, 5-bedroom, 4-bath. If you're looking at the visuals, you can see the pictures. This is a gorgeous home. It's on a gorgeous piece of property. It's got marble floors. It's in very nice condition. It's nicely decorated, nicely presented, beautiful home, high ceilings, ceiling detail, everything. Really nice home. $1 million, right? But what if we were moving from Jacksonville to New York City? Here's what we would get in New York City. A 653 square foot little apartment And this is called a one bedroom here on Zillow, but it's not even one bedroom. It's just a loft on the other side of the little living area. And below the loft is this tiny little kitchen with a mini dishwasher, a mini stove, and a mini refrigerator. Okay. So, and then there's this little mini balcony with a chair on it. Hopefully the chair is included for $1 million.
I certainly hope so.
Yeah. And that's the difference. People simply have to accept less. That's what inflation does. It diminishes the standard of living. It diminishes the quality of life. So it's not that people won't live in a house, whether they rent it or buy it. It's that they just get less. That's the sad reality of our centrally planned economy and the way the Federal Reserve has debased the wealth of the nation and the world.
Yeah, now that you have this new environment where people are working from home more and more, right? All this remote working, right? You know, being able to move to Florida and buy a beautiful home for $1 million, right? Is more of a reality than it was, 2-3 years ago.
And a lot of people have done just that and are continuing to do it, as we know.
Absolutely. So one of the things I love that you teach is called the Hartman Comparison Index, because many times we get stuck in our own minds comparing, the cost of a house to dollars, right? As investors, we obviously we look at the cost in dollars, right? But over time, if you look at that cost in terms of different commodities, it starts to help you adjust where we are with the housing market and whether we truly are in a bubble. So maybe if you can talk a little bit about the HCI a little bit.
Sure. So the HCI is my index that I invented. It's called the Hartman Comparison Index. And what it does is it compares the price of housing to a whole bunch of other things. People make a huge mistake when trying to analyze the housing market. They only compare it to one thing, US dollars. And that can create a lot of blind spots and a lot of mistakes. People need to compare housing to many things. That's just logical that you would do that because the dollar is a moving target. We all know that its value keeps changing. So we've got to use several measuring sticks when we make these comparisons to more accurately understand value. And these numbers are all about to be updated for the end of the first quarter. So these are last year's numbers, okay? Let's take a look. The Hartman Comparison Index answers what I believe is life's most important question. Compared to what? That is the question of life. Whether you are buying a house or analyzing investment alternatives or looking for a date or a mate, you're always answering the question, asking yourself the question and answering it, hopefully, compared to what? That's life's most important question. And that's what the index does. It helps us compare things. So when we look at this, let's understand, first of all, there are 3 types of real estate markets in the US and around the world. There are linear markets that are slow and steady and we believe the most profitable markets. There are cyclical markets that are like a roller coaster. They go up and down in price. And there are hybrid markets. Obviously, those are between the two. And when we look at linear market, that would be one of the markets that we've helped hundreds of people buy in, and that's Memphis, Tennessee. So Memphis is a very linear market. If you look at the price chart over time, it's really pretty boring. It has some small ups and downs, but it's pretty linear. Indianapolis, another market I've helped hundreds and hundreds of people buy properties in, and I've owned properties in both of these markets myself. And here, also very, very linear market, boring. But where I grew up, Los Angeles, California, that's a cyclical market. And so it has big ups and downs. It looks like a roller coaster, doesn't it?
Yeah.
Yeah. So let's just understand that first of all, but then let's get into some comparisons, okay? So when we compare the price of real estate to gold, now I'm not a gold bug, but gold is a good comparison because it's been considered money for thousands of years. Yeah. And if we look back to 1970, the median price house was $23,000. Gold was $35 an ounce. It was controlled by the government until 1 year later, basically, when Nixon took us off the gold standard. It took 654 ounces of gold to buy the median price house.
Wow.
10 years later,
expensive there.
Yeah. 10 years later, though, in 1980, the house price in dollars tripled to $63,000. Gold, though, went up a lot. It was $653 an ounce. And it only took 97 ounces of gold to buy the median price house 10 years later. But let's keep going. 1990, the house price went up by a third. It was 94,500. Gold went down a little bit to 415 an ounce. It took 228 ounces of gold to buy the median price house. So if we go to 2020, for example, we'll just fast forward a couple of decades. The house price was $309,000 and gold was $1,888, and it only took 164 ounces of gold to buy the median price house. So the real question we want to ask ourselves is, compared to gold or priced in gold, is housing cheap or expensive? And of course, it's had its ups and downs over the last 52 years, but overall, it's actually pretty cheap, priced in gold. But everybody's only comparing it to dollars, and that's a huge mistake. So what about oil? Oil is arguably one of the most important economies on planet Earth, okay? Regardless of what the environmentalists say, wind and solar ain't cutting it. The world runs on oil still.
Yeah,
now,
oil is our number one commodity.
Yeah, but it is the world's possibly most important commodity. And so in 1970, oil was $4 a barrel. House was $23,000. It took 6,400 barrels of oil to buy the median price house. Fast forward to 2000, it took 5,200 barrels of oil to buy the median price house. So in 30 years, from 1970 to 2000, housing actually got cheaper, priced in oil, one of the most important commodities in the world. Well, by 2020, it was 6,500 barrels of oil to buy the median price house. And by the end of last year, it was only about 4,500 barrels of oil to buy the median price house. So priced in oil, housing has gotten cheaper. Now, it's been really crazy after Russia's invasion of Ukraine and the oil prices and so forth. So this will be updated in just over a week. We will have updates to the index. And, of course, it went way up, which meant the price of a house in oil got much, much cheaper. And then it's come down a little bit since. And so, we'll see where it is when the new index numbers come out on all of this stuff. Let me give you just one more, okay? Priced in oil, is it cheap or expensive? It's fairly cheap. Not the cheapest it's ever been, but fairly cheap. Rice. Rice is the basic food stock of about 2/3 of the world's population. And priced in rice, housing is actually historically, fairly reasonable. It's not super expensive. And this is the problem when people only look at dollars. They are creating huge blind spots for themselves. And that's why the Hartman Comparison Index is so, so important.
Yeah. And so when we look at housing as a basket of all different commodities, right? Lumber, steel, concrete, asphalt shingles, things like that. And we see commodity prices increasing, it's just another indicator that I think housing prices still have room to run higher.
Yeah, they do.
We look at all these different things, we look at your HCI, comparing it to other commodities, right? We look at what investors are doing. 33% of home buyers today are investors. We look at what commodities are doing, right? Heading higher because a lot of different macro issues in the world today. It gives some good rationale to housing prices going higher. So, for the viewers, these charts that Jason is presenting, they're incredibly important to understand. And this is just a small little piece you get through Jason's Empowered Investor workshops and what you get through his Creating Wealth.
Yeah, a lot of stuff on the podcast, the Creating Wealth podcast, and on YouTube, my YouTube channel too.
Exactly. So if you're not following Jason, you absolutely need to follow him. So one of the questions I always get asked is, for the first time home buyers, right? Or investor really, right? So investors want to invest, but they're having trouble wrapping their head around why housing prices are still can be seen as cheap today, right? And still room to go higher. What do you recommend for first-time real estate investors? Should they buy a single-family residence? Should they buy a condo? Should they buy a duplex? Which is the best, in your mind, do you see as an investment strategy?
Anything 1 to 4 units is considered a residential property and has the really good, attractive residential financing with it. And, my favorite is the humble single family home. And, it's not just my favorite. If you call investors the smart money and you look at these big institutional investors like Invitation Homes and American Homes for Rent, I mean, these companies own tens of thousands of single family homes. They like single family homes the best as well. And I just think that is the most historically proven asset class in the entire world, the good old single family home. Duplexes, triplexes, and fourplexes, they're not bad. You generally get a little bit better cash flow with them, but you get a little lower quality tenant usually. So there are trade-offs like with everything in life. But the good old single family home, it's my favorite.
Yeah, and I think one of the pros associated with investing in single family homes is, just to touch back on something you spoke about, the quality of life people are going to be experiencing going forward with inflation. If they can't buy their own home for whatever reason, they might opt to rent a single family home, right? So single family residence as an investment, like you say, you could rent it to good quality people who just can't afford or don't want to buy their own home. But then as far as, liquidity, I also look at liquidity as a strategy of things, right? Liquidating, selling a single family residence is much, much easier than selling a duplex or a quad, for example, right? Because your investor pool is smaller for those duplexes, quads, things like that. Whereas a single family residence, you might have another investor buying it off of you. You might have, just a person wanted to buy it for their primary residence. So liquidity is a thing I look at and reason why I like single family residence.
Yeah.
So one of the problems people are having today is trying to beat these cash buyers out there. How does a first-time investor create an edge for themselves to beat out these cash buyers?
Well, they just have to learn to accept that we're in a market with multiple offers, and the list price is not that meaningful anymore. The values are just going up with every comparison. Now, granted, that could change at some time for sure. Everything's dynamic, but you got to just be willing to get in the game. That's the most important thing, is just get in the game, have investments or properties that are sustainable. If they're on the entry level end of the spectrum, those properties have the highest demand because you can catch people moving out into their first home, moving up the economic ladder, growing families. And if times are bad, you catch people moving down the socioeconomic ladder. And so either way, you're going to be in good shape with that bread and butter entry level style of house.
Thank you, Jason. I did have a viewer pose a question that they wanted me to ask you specifically. So they wanted to get your thoughts on short-term rentals, not only in the United States, but also short-term rentals outside the United States, for example, the Virgin Islands. What do you think about short-term rentals?
I think everybody needs to be really careful with short-term rentals. We've seen a massive increase in the number of non-primary beds in the world. Okay. Hotels have been constructed. Airbnb units have been just created like crazy. In an economic downturn, the first thing to go is going to be vacations and travel. So be really careful and just remember that Airbnb, like Bitcoin, are both very young. Those are teenagers. They are not yet proven. They have a long way to go to get through some real economic cycles, both of these things. So they are very, very young. So I would be careful. I would not look at that as a primary strategy. I think it's okay as a secondary strategy. Once you've got your primary good, solid long-term rentals, that's the way I'd look at it.